Okay, well, I might have capitulated yesterday. That doesn't mean I'm not still in my thesis and believing my thesis. I'm looking at everything, and I think today was quite an extreme example of what can happen and what is actually happening out there fundamentally. And I'm seeing signs and beliefs, we'll call them just beliefs because they have been so wrong, as many beliefs are, that things are getting ready to turn around. And I think it's going to come around at this Fed meeting. It's a very big battle of the market versus the Fed. The saying is, don't fight the Fed. That is tried and true wisdom. We obviously knew that was correct all of last year, but this year, something changed. I don't know exactly what. It seems as though that at least part of it, is the fact that SVB went under, the banking crisis happened, and then every single yield on the curve came down quite dramatically. Rates came down, and they really haven't gone back up. They haven't gone back up to where they were before, despite the fact that the day before SVB went under, Jerome Powell said the era of secularly lower rates was likely over, meaning over for good. The last 40 or so years that we've had of just rates falling down, and growth stocks just going up, because growth and rates it's an equation on that era is likely over, okay? Very big thing. They're not changing that. And if you look at and understand and read between the lines of what they said today with regards to the SVB failure, in my opinion, they're not swayed from this. The market has adjusted its rate expectations and its rate pricing under the assumption that the Fed is going to not be as aggressive, that they're going to be feared around the fact that rates went up. They're concerned about the contagion effect. It's a game of chicken, and Wall Street is going to win the game of chicken, even though Kashkari said the Fed is going to win the game of chicken against Wall Street. Wall Street is betting that they're going to win the game of chicken. However, today's report, where the Fed got the opportunity to place the blame where they wanted to place the blame, was not on rate hikes, was not on Fed tightening, was not on balance sheet reductions or any of these things. The blame was squarely placed on mismanagement of risk. What does that mean? Mismanagement of interest rate risk. People expecting that the Fed isn't going to do what it's going to do. And if you've been watching this channel the past several months, you'll know that the disparity between what the Fed is saying they're going to do and what the market is pricing is currently the most extreme it's ever been. Let's dig into that a little bit more. At the last FOMC meeting, the Fed put out a dot plot. Let's not forget, this was shortly after SVB. It was in March, just a week or 2 weeks, a couple weeks after, a couple days after, some short period of time after SVB. Still a tender subject. A lot of people expecting the Fed to come out and be dovish after this. However, what they did was they moved the dot plot more hawkish than it was just in December. However, rates did not adjust for that. They still decided to continue to fight the Fed. However, the commentary since then has been certainly hawkish. Again, rates really not moving since, but they said some crucial things we need to understand. Many Fed members wanted to go even more hawkish than the already more hawkish dot plot, but they wanted to see how SVB things settled out. Now we know what's happening. Hasn't really spread, hasn't gotten that much worse. Yes, FRC, but whatever. It's one bank of just rich people, and they decided to take all their money out. They took a lot of money out, is what it is. The situation hasn't gotten worse. The Fed is now saying that the whole bank debacle was not due to interest rate rises. So all signs indicate that they're not concerned about their rate hikes. Additionally, inflation staying high. Now, and we'll get to that in a second, actually. I want to talk about this first. What is the outlook for the Fed? What is actually in that dot plot? You know what's in that dot plot that they said probably would have been higher, but they wanted to see SVB shake out for a little bit? An upward bias to one more additional rate hike. What do I mean by that? The mean or the median, a lot of Fed members, if you take all, the middle Fed member is saying just one more hike in May. There's one person at the very bottom who decided no more hikes, no hike in May. We'll stop now, we'll pause, we'll see what happens. And then there's seven Fed members who expect at least a May hike and a June hike. There's 4 who expect at least a May hike, a June hike, and either a July or August hike. And then there's 1 who expects a May, a June, a July, and possibly a September or whenever that next meeting is. So the bias is up. The market is not there. I'm not saying they're going to go to September. I don't know if that's going to happen. What I do know is this PCE data that we just got, it's inflationary. This is what's going to cause them to hike more. Core inflation is not moving, okay? It's not moving. That's just the reality. You can look at headline inflation and say, oh, it's falling. The Fed explicitly says that they are not looking at headline inflation. Why? Because it factors in food and energy. And those categories of inflation are extremely volatile. We know what's happened with energy. It's come down. Everything indicates it's going to go back up. There's been like 11 out of the last 13 weeks of declining gasoline inventories. And this is with SPR releases. They had to go back to SPR releases. They can't do that much longer. That's just a short-term thing. This is not like the SPR release we had in the past. It's a really necessary Band-Aid. This was like some sort of, attack at OPEC, and OPEC is winning the battle because they cut. It's a battle. Oil prices are likely to go higher. So expect that headline inflation to remain sticky, but it doesn't matter because core inflation is basically doing nothing, okay? If you look at it, if you spend a couple minutes looking at that dot chart, not just looking at the trend and dipping, if you spend some time looking at it, seeing where are the tougher comps, where does the rate of change kind of make sense, you'll realize that it's really just flat. It's really just flat. And just flat is not good enough because we're just flat more than double the inflation target, and we've hiked interest rates all this way, and look at the progress we've made. Basically nothing. And don't take my word for it. The Fed members are saying basically no progress on core inflation, okay? It's not just me. I'm not just this guy making up this fantasy stuff. I'm going with the Fed. The market is blatantly and outright fighting the Fed. The Fed just said today in the SVB note that the SVB's failure was because they mismanaged interest rate risk and essentially fought the Fed. So, I get it. I've been taking losses this year. It's been rough. It's been rough listening to me. It's been rough being me. It's been rough being my clients, at least with their allocation to me. But I remain fully convinced that this is the way to go. To be short, that this crazy market is crazy. It's simply crazy, and it has to be short. I get it. The timing has been brutal. It has been brutal. But maybe the time is now. Maybe the time is now. There's a Fed meeting in a few days. Apple has strategically put their earnings after the Fed meeting. Tech companies like to report together. Why is Apple all the way out here on a Fed meeting day or after a Fed meeting day? I don't know. Maybe because they're having revenue and earnings declines. Maybe. I don't know. Maybe. We're going to find out. So I'm convinced if you really look at the earnings picture, this week was clouded by like 2 companies. It was clouded by Microsoft and Meta. And it was really only Meta that mattered. And somehow that gave us the strongest rally of the year. Somehow that did. I don't know. It sucked. Right before Microsoft, we were out there chilling, doing fine. Look at Google. Google was down after earnings. They were up initially after earnings, gave that entire gain away. Then they were up a lot on earnings that weren't even theirs. Meta, who actually experienced a 19% earnings decline and said an area of the business that they're trying to reshift their focus, Reels, doesn't monetize as efficiently. Okay? What are we talking about on this video? We're talking about facts and fundamentals. We're not talking about animal spirits. We're not talking about delusion. We're talking about facts and fundamentals. And I get it. Again, it has been painful. But it was painful for everybody else last year. And it wasn't painful for us. I'm hoping that turns around. We'll see what happens. But basically every other company that reports earnings is down. It's either down or it's showing weakness after reports. Even Meta. The high was the open after the report. The stock has just been drifting slightly lower since. Intel, the high was after the report. It's been drifting lower since all day. Amazon, the high was after the report. It's now down 4% today after being up 12%. You obviously know that. Again, it's a crazy market. It's tough being short. The saying is also the market can remain irrational longer than you can remain solvent. I'm learning a ton of lessons about that right now. I obviously had it easy going last year. This year's a different year, and it's been brutal, and the market has fought the Fed in a way that's unprecedented. But we are getting all the signs indicating that the Fed and the market are extremely dislocated. And there's a meeting in just a couple days. So let's see how that goes. That's today's video, and until next time, peace out.